Hello and welcome into the KE Report. I'm your host, Shad Markwitz, and today we're getting an update on Blackrock Silver, traded on the TSX.V under the ticker BRC, and on the OTCQX under the ticker BKRRF. And I'm joined today with the president and CEO of Blackrock Silver, Andrew Pollard. And Andrew, it's great to get you on here at the end of the year just to look back at 2024 and the accomplishments that you had at the Tonopah West Project. This is your flagship project in Nevada, very close to the town of Tonopah. And you had a lot of key catalysts in 2023 and 2024. I guess the big thing this last year was the PEA coming out on the updated resource. But walk us through the key milestones from this year. And then as we move forward, we'll start looking at 2025.
Yeah, great to be back here with you, Shad. And we've got three more trading days left before the end of the year. So you know what? Anything can happen. But it's definitely been a meaningful one for us at the project level. 4 years ago, we were just getting started with this. We had, I think, our discovery hole in July of 2020. And since then, we've now put out three technical reports in 4 years, going from discovery to what's looking like one hell of a mining operation on the back of our PEA, which we got out there in September. And I think that really, answered, a lot of the question marks in the market perspective in terms of, what are these ounces really going to be worth? What sort of operation is this? And we laid it out. And what we've got in our hands here is a very, very high grade, straightforward, boring operation that's going to be spitting out a lot of cash between just gold and silver production. What we're looking at, 8.6 million silver equivalent ounces per year at sub $12 all-in sustaining costs. So this is going to be either the lowest or one of the lowest cost silver producers in the world when all is said and done. And from a domestic point of view, I mean, this is the potential to be the second largest silver producer in America on a equivalence basis. And the thing about this is it's easy to drive it forward too. Being on private land in Nevada, we're not looking at another 10 years to get it there. This is something that we're going to be just meaningfully moving forward over the next 12 to 16 months as we gear up to try and get this thing underground during 2026.
Well, Andrew, let's dive under the hood a little bit more on the economic study you put out earlier in the year. We addressed it when the study came out, but just for those that are maybe not familiar with it or haven't kept up, show people the economics of the project as it is now. And you're, obviously expanding the resources there this year to bring even more in. But just with the PEA you put out in September, remind people the economics of the project and then also some of the sensitivities to higher metals prices.
Oh yeah, well, for a base case economics, we use $23 silver and $1,900 gold, which now seems like a very, very distant memory. And at that, we came out of there with a 2-to-1 NPV to CapEx ratio. So it was about $325 million after-tax NPV against a CapEx of $178 million. And even in that CapEx, we had about $20 million worth of contingency. So, just at those base case numbers, you're looking at just a smidge under 40% after-tax IRR. So really, really robust numbers, even at those low cash costs. But what that really, should impress upon everyone is that, this is a project that's going to work in any pricing environment out there. At 570 gram per ton head grade, which is what we're averaging for the mining operation here, there's nothing like this in the silver amongst the developers right now. I mean, we're 55% higher head grade than our next closest peer comp in the industry. And as you know, grade is king. So, even though it works at these low base case numbers, where things get really exciting is the torque you get to higher prices. Even for our upside case, we did base case plus 20%. So it was 2760 silver and 2280 gold. And at that, the MPV rockets up to just under $500 million MPV, and the IRR goes up to about 54% after tax. And I mean, that's at 2760 silver and 2280 gold. I mean, people are bemoaning the fact that gold sold off to 2650 right now and silver's 2930. Well, I mean that's substantially higher than even our upside projections go. So, we've got the makings of something truly special here, and that leads to the next 12-month work program we've got. I mean, I don't think we'll ever have a better return on investment, meaning the dollars we put into the project versus the NAV accretion that we'll get on the back end of it. And we're well on our way. We brought drills back to the project where we completed 20,000 meters of drilling just between August and mid-December here, where we're focused on de-risking through the early years of production. So the PEA had a 2.3-year payback period. Well, what we're trying to do is drill out using the mine plan that the PEA is working from the first 3 years or so of production, meaning make it a no-brainer to build this thing. The other thing we're doing is we're tackling the back end of it too. Right now the PEA's got an 8-year mine life. We think we can take that well beyond 10 years with just the drilling we've got in front of us. And where we stand right now, I think we've got a minimum of 20 drill holes working their way through the labs. So, this year we've been able to convey the value, and next year I think is where we'll really be able to start breaking out from the crowd. Because once again, I mean, there really aren't that many other developers in the silver space. Certainly, there's not many pure precious metals ones like BlackRock has. But, where we'll really be able to pull away from is by continuing to demonstrate the continuity of the high grade and showing the market that this thing's gonna should be a cash cow, and then just bolting on the low-hanging mine life that we've got in front of us. So, we plan to hit 2025 strong right in January with both results from our M&I conversion program to release, in addition to the first of our expansion holes, where we're testing about a kilometer of mineralized trend, which bolts right on from where this mine plan leaves off, and it connects with a 12 million ounce orphan deposit 1 kilometer away on the exact same vein corridor. So we think we can add a lot of ounces here in the short term.
Well, Andrew, let's dive into it a little bit more as far as the drill program and just remind people when you put out the 100 million ounces, which people had their doubts initially and they don't have those doubts now, but you put out 100 million silver equivalent ounces. That's the combination of the silver and the gold, as you mentioned, a pure precious metals play. But just remind people some of where the action is and where the M&I conversion's going on, but also where that expansion's going on as you connect to that 12 million ounces that didn't make it into the first resource. But also, it seems like a lot of the work was done previously at the DPB vein, the Victor vein. We've talked about the Bermuda vein as another area. We talked about the Denver vein. So just remind people, where is the M&I action happening and where is the expansion area happening?
Yeah, well, the shallowest portion of our property is at the southern edge of an area we call DPB. It's in the effectively the center of our patented claim block down there. And those are the early years of mine life because it's the shallowest portion of the project. Now, what's really nice about this area is that it happens to be what we think is the highest grade structure in the industry. If people look at our mine plan from the PEA, you'll see the early years of production there. You're in a stope that's 980 grams per ton silver equivalent. So just a hair under a kilogram per ton silver equivalent. And that's drilled out using our inferred drill spacing. What we're doing right now is going back in, targeting those same structures, our Merton and our Bermuda vein specifically, and tightening up that drill spacing on 25-meter centers. And what's been really beneficial for us is not only, I guess there had been some skepticism into whether the high grade hung together, just given how we were trading to start the year, and given how much we moved on the back of our first set of conversion results when we actually proved that the high grades are the continuity there is really phenomenal. But one of the nice things that emerged is we hit up dip outboard of the current PEA and resource shell. So the PEA envisions mining starting around 200 meters below surface, but we had every reason to believe that that mineralization could be followed up dip towards surface. So we've actually hit a brand new zone, a brand new ore shoot, starting from about 130 meters, 140 meters down hole. So not only are we tying together mineralization previously outlined on really tight drill spacing, but we've hit a brand new zone, so we'll be bringing in some new tonnage. So not only are we focused on adding expansion ounces towards the back end of the mine life, but because we're drilling near surface material right off the bat and can bring mining forward even earlier, we should have some pretty clear potential to front load mine life too, and really, compress that payback period down significantly and help blow out our next set of economic numbers. So, I guess to take a step back, I mean, this is a district historically that in about 30 good years, it produced about 400 million silver equivalent ounces. And it was thought to be an east-west vein corridor. So the original production from the district happened on the east side of town, where actually the town of Tonopah sits today, where there were outcropping veins. And the old timers, I mean, it led to a massive gold rush. The last real gold rush in Nevada prior to World War One. You had some big time mining companies set up shop in the early 1900s. And what they did was they followed those veins from surface underground. And all of that production, that 400 million ounces, it started on the east side and it started moving its way westward. Well, the last producing mine in the district, it was called the Victor. It was the Victor Shaft, owned by the Tonopah Extension Mining Company. It happened to be the thickest vein in the district. Where they stopped mining it, it was 24 meters thick. And really, what we've done 90 years after production last shut down there is we've now kept moving on that Tonopah Extension Mining Company claim package that we were able to piece together in March of 2020. And we've now drilled out roughly 4 kilometers of cohesive mineralized vein corridor right from that last operating mine. So there's a lot of ounces that the old timers left for us at Victor. We've drilled it about as much as we possibly can from surface, but we've got no idea just how deep the plumbing there goes. And then we followed that along the vein corridor to the central area of the property, which is called that DPB area. And then we took a huge step out in the summer of 2022, where we decided to project that vein corridor another kilometer. So we stepped out a kilometer from where our last drilling at DPB was, and we hit a brand new area, which we call the Northwest Step Out. And that gives us a kilometer of mineralized strike that we've yet to really lock in via the drill bit. So that's really what we're doing now. So, it looks like we've got three different resources or three different deposits on our property, but that's not really the case. What we've got is one big high grade mine that starts very shallow. And as I said, we're going to be hoping to de-risk through that payback period with the M&I portion of that drilling to be finished in early January and a lot of drill results to follow. So, yeah, it's right now. I mean, the project looks pretty good as is, even if we didn't add another ounce. I mean, given the economic profile, this is something that would get built, but it's going to look a whole lot better by this time next year.
Well, Andrew, let's also talk about, we've mentioned it in the PEA that there's some sensitivity to higher metals prices, but since you have the highest grade silver equivalent project in development that has over 100 million ounces, it looks like some of the results we just talked about in October and November actually are even higher grade. So I guess, is it possible to raise the grade profile even larger and maybe just speak about the leverage you would have if we do see silver go on a run next year or gold resume a run? Because even though they've pulled back a little bit the last couple of months, a lot of people are looking at silver in the mid 30s or even the high 30s next year. If that was to happen, what does that mean as far as the leverage you have, and how are you looking at the silver market right now?
Well, listen, I see, given the initial results that we've seen from the M&I program, and the rate at which we're hitting, I think it's an inevitability that our M&I grade through those early years is going to go up meaningfully from the inferred grade that was laid out. I mean, we've hit some of our highest grade intercepts ever at Tonopah West in this M&I conversion program, and some of those are even outboard of the existing resource. I mean, we hit 8.5 kilos from about 160 meters down hole, which is the highest grade intercept we've ever had at the project. But, this isn't a project. I see some of our peers putting out some absolutely wild drill holes where they'll hit like 12 or 15,000 grams per ton, and then you'll see a bunch of like two or threes. With ours, you're never going to get a 20,000 or maybe a 30,000 or whatever intercept. But what really stands out about our project is just the continuity of the grade dispersal. There's a continuity of a few things. One is the grade, and the other is the silver to gold ratio. When you're on the system at Tonopah West, you're gonna be pretty much invariably it's 100 to 1 silver to gold ratio. So if you hit a kilogram per ton silver equivalent and you get, assays from the lab back just on the gold side, say you get 5 grams gold, you can pretty much count your bottom dollar that you're going to get something in the order of 500 grams silver. So we've got very, very good continuity of the grade profile and continuity of that silver gold mineralization as well. In terms of the M&I grade, just by infilling the holes in a 25-meter center as opposed to the 60 or 70-meter center that they were drilled out for the inferred, you're going to see the grade of the M&I ratchet up anyways, just as long as you hit in line with that grade because you're not penalized as much. But as you said, I mean, we've put out no shortage of kilogram plus intercepts thus far, and we've got a lot more to come. We're infilling as once again what we see as the highest grade structure in the industry. So I think that, it won't be a surprise if we can get the M&I well above a kilo. And if that's in your early years, you're going to see that payback period compress meaningfully between now and our next economic study.
Well, Andrew, since you're very involved in the silver and gold space and you're developing this project, Do you have any prognostications for us as we're at the end of this year and we look forward to 2025 on what we may see, not just in silver and gold prices, but just in the industry? This was a year where we saw a lot of M&A. Do you think that trend will continue? Any other thoughts just on the sector in general?
Yeah, well, 2025 is going to be a very, very different silver market in terms of who the big players are than previously. I mean, just since September, you saw First Majestic and Gatos get swallowed up together. Then you saw Coeur come out and take Silvercrest, which was, one of the highest margin, highest grade projects out there. And what you're seeing is none of these deals have closed yet, but I expect they'll close probably in Q1 of next year. And those are going to be two absolute powerhouses. What you've seen a lot of the large single asset, high margin producers get swallowed up this year. Typically, if a company is going to make an acquisition, it's got to have meaningful production. So, I mean, the silver market's littered with small producers that aren't going to move the needle and might not have that same takeout allure, and they've lost two of the highest margin producers. So really, I mean, there might be only two or three other takeout worthy projects, single mine producers in the industry. And you're going to have two companies coming out with some really impressive balance sheets. Certainly, Core is going to be in a really good position and hungry to build out their pipeline, given they've got Silvercrest and the Rochester expansion should be done. And First Majestic and Gatos should be quite formidable as well. One company that people haven't been talking about as much recently is Hecla. And Hecla, after going through a long succession search for their CEO, they brought in an outsider, someone that I think is also going to have a pretty clear mandate. This industry has a lot of assets that are getting quite long in the tooth. There haven't been certainly many meaningful discoveries in the last decade. I'd put us in that category, Vizsla's in that category. And then there's been a lot of assets that have been around the block and held by various companies over the years and maybe developed or not developed. But if you want to look at what, I think 2025, you might see the premium acquisitions come into the developer space just because there's really not much else there that'll move the needle for the producers. And, granted, where we're trading right now, I'd lose sleep if someone were to try and make an acquisition. I mean, I'll put it this way. Silvercrest just got taken out for $2 billion in their second year of production. Their second year of production, they're producing about 10 million silver equivalent ounces at I think 12.50 an ounce. Well, our second year of production should be somewhere between 11 and 12 million silver equivalent ounces. That's like 67,000 ounces of gold and over 5 million ounces of silver at sub $12 costs. And I'm trading at $100 million valuation right now, Canadian. So what we can do internally is add as much value via the drill bit this year. I think that you will start to see some premium acquisitions happen in the development space, but from our perspective, this is a project that can be moved forward very, very quickly. And by moving it forward quickly, we can re-rate quickly. So by getting M&I ounces, that's going to be one thing. By showing the market that we can take this well beyond 10 years mine life, that's another thing. Something else we're doing that'll shorten the period it takes for us to actually break ground on it is kickstarting our environmental permitting so that we're in a position to break ground when it makes sense. So we're focused on getting our water rights, all things that you need to be in a position to ultimately, you have to be prepared to build this thing yourself. But I think this is something that a lot of people will want to buy to build as well, given the jurisdiction. But right now we're undervalued. I said, we're 55% higher head grade than our closest peer comp, and we're trading at about a 50% discount on a EV ounce basis. That's despite being higher grades, despite being in America on private land next to a town, and it's despite it showing that these ounces aren't marginal. These are going to be some of the highest impact economic ounces in the industry when all is said and done. So we're going to hit the ground running with a lot of catalysts in terms of, we've got a lot of cash in the bank right now. The drills are coming back in January, where we're going to keep chipping away at locking in expansion ounces. And we've got a lot of expansion holes in the lab that we hope to release in January, which should really kickstart, I think, our market. And we've got a whole lot of, I guess, the last of our M&I holes to release here, which, if all comes together as planned, we should have about 3 years worth of production just on those. So we'll see. This year was very much a push for the first 9 months as we tried to convey the value, convey just what a robust operation this is. And, since we started getting the drills back and since we've gotten some renewed interest amongst analysts and large scale investors, it's gone to a pool. So, I think we're being pulled into 2025 in very good order here. And I think we're going to be one of the more active companies in the industry next year as we add not just ounces, but mine life and drive some value.
All right. Well, I think we'll wrap it up there for today, Andrew. It's a good snapshot of what's coming down the pike in 2025. A lot of catalyst, a lot of drill results to put out, expanding the resources, filling in the M&I, possibly raising the grade profile in a safe jurisdiction in Nevada on private land. So a lot to follow along with. And if people listening in want to follow along with the news, definitely click on the link below this interview. It takes you right over to the BlackRock Silver website, straight to their news section where you can sign up for updates or just follow along with the news as it's released to the market. Andrew, it sounds like it's going to be a busy first quarter, so keep us posted of more news. We'll get you back on for an update. And as always, looking forward to our next conversation.
Thank you. And we'll be presenting at Metals Investors Forum in Vancouver at the Fairmont Pacific Rim on January 17th and 18th. So if anyone's going to be in town or wants to see the presentation will also be webcast simultaneously. Please feel free to drop by the booth or certainly log in and we'll have it out there for everyone. But good luck and here's to a good start in 2025. Thank you.